Most trading education obsesses over entries. But decades of quantitative research reveal that edge is fleeting unless it is harnessed by position sizing and psychological grit. Today we move beyond vague rules like "don't risk too much" and build a rigorous framework. We will derive the position size from a risk budget, prove why a positive win rate alone means nothing, apply a simplified Kelly Criterion, and confront the behavioral traps, loss aversion, regret, and the illusion of control, that silently drain accounts. This is not motivation, it is a quant's guide to surviving the long game. Imagine two traders with identical 55% win rate strategies and 1-to-1 risk to reward. The first risks a fixed 1% of account equity per trade. The second bets arbitrary amounts driven by confidence or emotion. Over hundreds of trades, the first survives drawdowns and compounds, the second eventually blows up. The difference is not the entry signal, it is the robustness conferred by sizing. In this slide we lay out the core principles. Position sizing must be systematic, derived from a risk budget, and immune to the trader's emotional state. The math will follow. The fundamental rule: never let a single loss threaten your capacity to play again. We set a maximum acceptable loss per trade as a fraction of total equity, commonly 1%. Then the position size is simply the dollar risk divided by the distance from entry to stop. If a stock is priced at $100, your analysis places a hard stop at $95, and your total account is $10,000, your risk budget is $100. Dividing 100 by 5 gives 20 shares. This arithmetic enforces discipline. You scale up only when volatility contracts, and you scale down when it expands. It is a self-correcting mechanism. A high win rate is seductive but incomplete. The real measure of a trading edge is expected value, or EV. Even with a win rate under 50%, a strategy can be highly profitable if the average win is much larger than the average loss. The formula multiplies the probability of winning by the average gain and subtracts the probability of losing times the average loss. If the result is positive, and the setup repeats, the law of large numbers works in your favor. Without a positive EV, no amount of position sizing can save you. It only determines how quickly you go broke. If you know your exact win probability and the payoff ratio, the Kelly formula tells you the optimal fraction of capital to allocate in order to maximize long-run geometric growth. A simplified version uses the win odds, divide the expected net gain by the odds received. For example, with a 60% win rate on a 1-to-2 risk to reward, the optimal fraction is 20% of equity per trade, aggressive but mathematically sound. In practice, trading environments are uncertain, so most professionals use a fractional Kelly, often half or quarter, to cushion estimation errors and survive streak variance. Behavioral economics documents that losses hurt roughly twice as much as gains feel good. This asymmetry leads traders to hold losers too long, hoping for break-even, while cutting winners short out of fear of losing even paper profits. The left column shows the disciplined trader who respects a stop-loss and lets winners run according to expected value. The right column shows the loss-averse trader who moves stops wider, ignores preset risk budgets, and exits profitable trades at the first sign of pullback. The result, over hundreds of trades, is a significant drag on compounded returns. Regret aversion, fear of making a wrong decision, manifests as chasing missed moves or refusing to re-enter after a stop-out. A stock surges 20% and the trader, having exited too early, buys back at the top to avoid the pain of missing out. The remedy is not psychological willpower alone, it is a system that quantifies opportunity cost. When a signal triggers, the position size is already determined by the risk budget, not by emotional urgency. If you are out of a trade, the next candle is just another bar, the market does not know you exist. The Sharpe ratio measures the excess return per unit of volatility. A strategy generating 15% annual return with 10% volatility has a Sharpe of 1.0, assuming a risk-free rate of 5%. A strategy with the same return but 25% volatility has a Sharpe of only 0.4. This metric forces you to ask whether your returns are from skill or from simply taking on more risk. When combined with position sizing, a higher Sharpe allows you to apply leverage safely if your system can scale. Low Sharpe strategies may need to reduce size to survive drawdowns. A 25% drawdown requires a 33% gain to return to the high water mark. A 50% drawdown needs a 100% rally. This table quantifies the nonlinear pain of large losses. It underscores why position sizing must cap the maximum percentage drawdown from the start. If you risk 1% per trade and experience a 30-trade losing streak, you are down about 26%, still recoverable with disciplined sizing. But if you risk 5%, that same streak wipes out nearly 80% of your capital. The table makes the case for a fractional, resilience-first approach. When trading is your sole income, the need to generate monthly cash flow collides with the probabilistic nature of edge. An otherwise robust system can be destroyed by the necessity of withdrawing funds during a drawdown. The mental load is geometric. Every red candle now represents a potential mortgage payment missed. Most successful independent traders have a secondary income source or a large cushion of non-trading capital. This slide lists the preconditions: at least 2 years of living expenses in cash, a verified positive expectancy, and the emotional capacity to accept a year of flat returns without panic. Even with perfect per-trade sizing, carrying 10 highly correlated positions simultaneously can create a single massive bet. The heat of a portfolio is measured by the weighted average correlation. If all your trades are long Nasdaq stocks, a tech sell-off hits every position at once. The formula here quantifies how position-level risk aggregates into portfolio risk. A disciplined quant allocates size inversely to correlation. The more interconnected the positions, the smaller each one must be to keep total drawdown within the risk budget. A discretionary trader may have an edge but often fails to execute it consistently under stress. A systematic trader encodes the exact rules for entry, stop, target, and sizing into an algorithm or a strict checklist. This left column shows the discretionary path: bias, fatigue, and emotional interference degrade performance. The right column shows the systematic path: identical execution every time, with deviations only from validated rule changes. The most profitable quant funds operate because they remove the human from the moment of execution, leaving discretion only to the design phase. The market is not a meritocracy of intentions, it is a brutal reflection of risk and discipline. Every concept we covered, position sizing from risk budget, expected value, Kelly, behavioral traps, and systematic execution, leads to one conclusion: your edge is only as strong as the size you give it and the psychology that preserves it. Use the formulas we derived. Check your Sharpe. Cap your drawdowns. And above all, accept that losses, missed moves, and flat periods are not failures, they are line items in the cost of doing business. The traders who last decades are not the ones with the best entries, they are the ones who size correctly and stay emotionally flat. If this framework changed how you think about your next trade, let us know in the comments. Remember, the market is always right, but your process must be built to survive it. Until next time, size thoughtfully and trade without ego. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.